It was a big bang front-loaded rate cut. If you ask me, actually, the entire policy, I would probably coin it across as one of the most iconic policies which I've seen over the last 15-20 years. Written a note also on this last month where we had covered this, that second half of the year, we might see some bit of liquidity requirement from RBI. So our perspective is that actually RBI has done significant moves in the last 4 months, and we feel now, and including RBI, that incrementally to support growth, monetary policy space is limited.
So where do you think, how should we understand this macro environment?
Opportunities and returns in fixed income market. I think the theme now moves to holding short-term corporate bonds.
Hello everyone. Welcome to Moneynomics by Axis Mutual Fund. I'm Shalini Gautam, and joining me today is Devang Shah, Head Fixed Income. Today, he will be sharing his insights on the latest developments in the fixed income markets, the evolving landscape, and what investors should keep in mind when they make their investment decisions. So, Devang, welcome to this session.
Thanks, Shan.
We have seen a lot of developments in the last few weeks. Could you walk us through all of these developments, particularly by the RBI? And let me break it down one by one, and perhaps we can take it that way. So, let's talk about the rate cut by the central bank.
So, right, I think last 2 weeks have been very exciting from bond markets perspective. First of all, obviously, the bigger element for change in bond market yields, direction, everything has been the monetary policy announcements. And as you rightly highlighted, I think the rate cut was a surprise. It was a big bang front-loaded rate cut. If you ask me, actually, the entire policy, I would probably coin it across as one of the most iconic policies which I've seen over the last 15-20 years, is because it was also there were a lot of surprises in the policy. You saw a big bang rate cut, you've seen liquidity measures, and there's somewhere down the line a stance change also. But it is also about giving forward guidance. So I think RBI has gone all out to ensure support to the economy, to insulate the economy at this point of time. And there were a lot of forward-looking guidance, forward-looking front-loading of rate cuts. So all of this happened in this monetary policy. Specifically to your question on the rate cuts, yes, as against an expectation of a 25 basis rate cut, RBI delivered a 50 basis rate cut. As per me, if you ask why RBI chose to deliver a 50 basis rate cut, is if we look across from a lens from RBI, it is how does a central banker think, he'll probably focus on 3 aspects. Is what is the outlook on growth, what is the outlook on inflation, what is happening to the external sector. Today, if I look across at the inflation outlook, I think RBI is superbly comfortable that inflation for the next 6 to 9 months, and actually they have lowered the inflation projection for the year also from 4 to 3.7%. But I think the next 6 months will be below 3.5%. So that gives RBI a lot of comfort that yes, at this point of time, the policy can tilt towards growth and support growth. Growth has been a bit weaker than RBI's expectation. And that is why I think there was a front loading of those 50 basis cut. The third important aspect is I think they are not worried about at this point of time too much about currency, because I think the larger capital markets are more worried about dollar depreciation today than INR depreciation. So in this context, I think to support the economy, RBI chose to deliver a 50 basis rate cut as against 25 and front loaded the rate cut.
We'll come to the macros aspect again later. But I want to understand from you, we also had a CRR cut and a forward-looking CRR cut. Could you tell us, walk us through about this rate cut?
So it's a very interesting move. In fact, that's why I call this policy as one iconic policy, because we have not only had a front loading of rate cuts, we've also taken care of insulate the economy, but somewhere down the line, RBI has been very, very proactive in liquidity management. And to give some credit to them, they've done a superb job in liquidity management since last 4 odd months. Since January till now, they've infused more than 10 trillion of liquidity. Our understanding is that there was some requirement in the second half of the year. We actually written a note also on this last month where we had covered this, that second half of the year, we might see some bit of liquidity requirement from RBI. So first half, I think probably they have taken care through various measures, and the announcement of RBI dividend takes care of overall banking liquidity upwards of 5 trillion. So banking plus government liquidity today will be upwards of 5 lakh crores, and we don't see any concerns on liquidity. But in the second half of the year, because of RBI balance sheet growth, somewhere down the line, there's also a forward book on Forex, which is short, which might lead to some drain on liquidity. We believe so. RBI anticipated that drain on liquidity and did a front loading of 2.5 lakh crores of liquidity measures right now. So a 1% CRR cut will lead to, in the second half, a 2.5 lakh crores of release of liquidity. And as per us, with this move, the overall banking system will be positive liquidity till December 2025 or even possibly till March 2026. So very, very strong positive move. And to ensure effective transmission, a communication to banks was required that yes, I will take care of liquidity for the next 12 months. Let's start transmitting rates lower. And that's the purpose of this front loading of CRR cut.
Okay. The third surprise was the change in stance. Now, RBI in its last monetary policy had changed its stance to accommodative,
Right.
and now it's back to neutral. Wasn't this a surprise, and how are the markets taking this?
In fact, if you ask me, that's the only reason why I think markets and sentiments have dampened a bit, and you have seen yields moving upwards and the direction of yields have slightly changed. Capital markets were not very happy with the stance change, but I think RBI again has been slightly forward-looking here and have tried to give a forward guidance. Let's start with first what all RBI has done over the last 4 months. As I told you, they've infused 10 lakh crores of liquidity. Secondly, I think the most important aspect is when you're looking at rate cuts, we should also price in the operative rate shift over the last 4 months. Beginning of February this year, 2025, we were at a 675 operative rate. Now with all of these rate cuts and liquidity measures, we're at 5.25 operative rate. So actually there has been 100 basis of repo rate cuts, but there's actually been a 150 basis of easing because of easy liquidity measures which RBI has introduced. So our perspective is that actually RBI has done significant moves in the last 4 months, and we feel now, and including RBI, that incrementally to support growth, monetary policy space is limited. And that is why they went all out to give a forward guidance to market. Yes, unless we see a growth shock or a significant lower inflation number, the space for monetary policy incrementally will be limited. And hence they changed the stance. So it's a very, very forward-looking monetary policy.
So this is about India. What about the markets globally? Treasury yields have been rising. We have seen quite a few, increase in yields. How is the reading of the US markets?
See, I think there's a lot of concern and worries about what's happening on US treasuries. Okay, and it's rightly done because US is going through a significant different macro dynamics today. We have highlighted time and again that US is in a different macro dynamics as compared to inflation. Pre-COVID, 10-year average, they were at 1.8 inflation. Today, they are at 3% inflation or a higher. If you look at the overall fiscal deficit numbers for US, they were at below 3%. Now they're at 7%. So somewhere down the line, I think US is going through its own challenges on macro dynamics and a lower growth environment. The US exceptionalism theme, which everyone was working on since Trump got elected or the Republicans got elected, I think the thought process has significantly changed at this point of time that US might not show significant strong growth. And the dollar depreciation might continue for a while. Plus, the entire fiscal burden is creating the worries on US yields at this point of time. Our perspective is that US macro has started to weaken actually, and it is lower growth. Unemployment has started to rise a bit. If you look at the inflation also, inflation is not going up so much. So we continue to believe that Fed will continue with a couple of rate cuts in the last quarter of this calendar year. So September to December 2025, we anticipate 2 rate cuts from Fed, and we believe that US treasuries will probably trade in this range of 4.25 to 5%. We don't see significant rise in yields from here on.
Okay. Now coming back to India, the macros seem to be pretty much in control. Inflation is falling, growth is stable, rupee you said is range bound. So where do you think, how should we understand this macro environment?
So see, my perspective is that rates are going to remain lower in India for longer. Okay. So because as you rightly highlighted, I think in the next 6 months, inflation is going to be low. We are in significant good external situation environment. Current account deficit will continue to remain at around 1 to 1.2%. Fiscal deficit at 4.4. Growth, even though that is weaker than RBI's expectation, I think probably India will show a next year growth above 6%. In that context, I think RBI will not be able to hike anytime soon. So yes, though the room for further monetary policy easing is limited, similarly, I don't see or give any kind of probability for rate hikes anytime soon. So our perspective is that markets will remain now in a range. Incremental rally will be gradual and slow. As per us, we were already highlighting that last year was the theme to hold long bond funds and government securities, because that will probably give you better opportunities and returns in fixed income market. I think the theme now moves to holding short-term corporate bonds and probably looking at short to medium-term funds as a strategy. So what we're advising client is the duration play is largely getting over. Now you should start looking at the liquidity play, which is on account of all the liquidity measures which RBI has taken. We believe so rates are going to remain low for long, and hence we are advising short to medium-term funds to corporates and clients at this point of time.
Okay. So then what is the finally, what is the outlook for the markets, and how should investors position themselves? I do know that you just spoke about duration being out and short-term bonds being in, but if an investor has to think about it, how should he be looking at the fixed income space?
So see, my understanding is from a macro theme perspective, there's still a lot of uncertainty. Like as you highlighted, there are global worries. People are worried about dollar depreciation theme. People are worried about growth in India. So in overall context, I would still urge clients that in an uncertain environment, they should have a higher allocation towards debt.
Okay.
Now in that debt allocation, probably as we highlighted, that they should lower the duration and probably now start moving towards short to medium term funds. Income plus arbitrage category, which is a new category, and I think a lot of mutual funds have come out with this category. This is a new product, offers you low volatility, and somewhere down the line it also is a far much better tax optimal solution for clients.
Thank you so much, Devang, for your insights in this session today, and a big thank you to all our investors for staying tuned in.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.